I'd like to welcome everyone here for our fourth meeting of the Communications Tax Reform Commission. We do have one new commission member here today. Philip Raines is our new consumer representative. Welcome, Philip. You can find all the information that we've done so far on the, we have a website for the CTRC, so that'll give you some cliffhanging reading to do. So, you can find that on the website anyway. We have an exciting agenda today, I think. Every member here is going to have the opportunity to hear the views of other members and then express your own opinions and really have some conversation of where we are going as a commission. We have a lot of experts on telecommunications tax reform here, but I think this has really, for those who are not experts, it has really given a lot of people more of a background of what the issues are that we're dealing with. So whatever comes out of this commission, I think for us as legislators, we've learned a lot from it. And so I think we've done really well so far, and I'm interested to see where we get to today as far as an end result for this commission. Right now, I'd like to turn the meeting over to Andy. He's going to lead a discussion on the report that we did, and that was distributed to members on Tuesday, May 7th. I'm hoping that everyone has had a chance to read it. And Andy, I'm going to turn it over to you.
Thank you, Senator King. First off, I wanted to thank everybody for participating in the survey. Many of you and your businesses or the governments you're representing actually filled out a survey. It was a pretty successful data gathering effort. As many of you know, it was a pretty, I would say it was a very detailed survey with quite a bit of information that required probably a lot of work for many of you or many of the people that you work with. We heard back from more than 300 businesses. Well, we had more than 300 businesses submit a survey, as I think we discussed a while back. We requested information from more than 1,100 because it was so difficult to identify who was a communications business, who wasn't. Many more sent emails back saying, I am not a communications business indeed. I will not fill out your survey. But we know that we got all the big guys. It's a fairly concentrated market. So we know we have a very representative data sample as well as many of the smaller players as well. And we do appreciate the efforts of everybody that helped us get the surveys in. We did get surveys from all of the local governments as well, all of the counties, and the municipalities that are impacted by what we're discussing here right now. So I think that was very good. I did want to reiterate the statute that called for the survey, and I'll just read it if you don't mind very quickly, which says that the Comptroller and the State Department of Assessments and Taxation shall collect data from communications service providers to determine the amount of revenue remitted to the state and local governments by each communications service provider in relevant taxes and fees on communications services during fiscal year 2012. So we did do our best to stay within the realms of what the charge was of the statute and not go any further than that. We have made one minor revision to the report. It's not really it won't change the impact of any considerations you've made. It was just to point out and make it very clear that the amount of dollars that we associated with the higher tax rate for public utility property, the dollar amount there is only the incremental value of that tax rate. So that is what that value is. That's the only change to the report since it's been distributed. And now David Van Remorter, who's been working with the data significantly, is going to do a presentation, and he's not just going to rehash the paper, but I think he's going to make some pretty good points that will be of value to the members. And we're obviously happy to answer any questions that you may have.
I'll make one more comment. I just wanted to make one more comment, too, before we get started. My goal today would be to come up with a consensus report. The goal would be. I don't know if that's possible, but if it's not possible, we at least can put together however many opinions that we have to go on to the committee. That's the main thing that we really want to do is get the information to the committees. Sheila Hickson from Ways and Means I talked to her today, and she would love to have a consensus report too. It would make it way easier for the committees to work, but I don't know if that's possible. And if it's not, we're ready to move forward with recommendations as we see fit. So that's on the table for the discussion today. Okay, great.
Very good.
Good afternoon. I will be making a brief presentation on the data collected by staff. A detailed report on the current communication revenues collected was disseminated to Commission members on May 7th and can be viewed through the Communications Tax Reform Commission's website. The following presentation, as Andy said, will contain additional staff analysis extrapolated from the data. Principally, I will be touching on 3 points through this presentation. I will touch on the 2 reform proposals that have been presented by Commission members and their fiscal implications. I will talk about differences between Maryland and Virginia, specifically in terms of differences with their pre-reform tax structures. And I will also touch on some unknowns that make forecasting revenues very difficult at this time under the current structure and any proposed structure. Next slide. The overarching question I'm looking to address in this presentation is, can Maryland enact reforms similar to Virginia's and hold revenue constant? The answer is yes, but in order to do this, we must account for the differences between Maryland and Virginia, particularly with their pre-reform tax structures. What Virginia did on a very high level was they essentially took a bunch of taxes and fees on the different services. There are different taxes, rates, different fees, and they removed them all and put a 5% rate on all the communications taxes. The 2 reform proposals that have been put forth are similar to this. This is at a high level. There are differences, but on the high level, the first proposal would take away all the taxes and fees on these services and put a 6%, the sales tax equivalent rate, on all these services. The second proposal would just reform the telecommunications industry. It would leave pay television unchanged. However, it would remove all the telecommunications service taxes and put the 6% on. Next slide, please. Well, these reforms, which are very similar, looking at Maryland's data, on fiscal year 12, the first proposal would have reduced revenue by $73.6 million. The second proposal would have reduced it even more, by $106.3 million. In order to enact the proposals, we would have had to put a 7.2% combined state and local rate on communications to hold revenue constant. To do the second proposal, we would have had to put on an 8.7% rate. So what's the difference between Maryland and Virginia? Why does it work in Virginia with a 5% rate, but it doesn't work in Maryland with a 6% rate? The main difference we've seen is differences in the pre-reform tax structure. Principally, these differences have caused the effective rate of the taxes repealed would be higher in Maryland than it was in Virginia. Also, on top of this, Virginia's pre-reform tax structure was expected to diminish in revenue just naturally. What we have here is a slide in reference to the first point about the effective tax rates replaced. These are the direct effective rates. They do not include things like sales tax on equipment. They do not include the corporate income tax, property tax. They are what are charged to the consumer on the service sale. Now, as an example to explain what direct effective rates is, if we go to the wireless rate there under the current system, the red line on the left there, what that is the state sales tax on wireless service, the local telecommunications sales and excise taxes that are levied by 3 counties currently, the 911 fees, the Maryland Relay Service surcharge, and the sales tax on ancillary services such as 900 type calls. You add up all those fiscal year 12 taxes and fees, and then divide it by the base, the gross receipts that of wireless, all the purchases, all the money that has been used to wireless by consumers. You see on the current rate, we have a 10% rate on wireless, the highest rate of all the services. Landline is next, followed by cable, followed by satellite. Now under the proposal, wireless is brought down, satellite is brought up, landline is essentially the same, so is cable. Looking at those graphs, you see that wireless is brought down, the rate is brought down less than the satellite is brought up. However, you're wondering why then are we losing $73 million a year? Especially Well, maybe, you might be thinking it's because those things do not include some of the revenue hits, like the network equipment sales tax exemption or the telecom property tax rate reduction. Those two together would be 40 million, so we still have about 35 million more to account for in a revenue loss. To account for it, you need to look at the taxable base of the different services. Number 1 is wireless, 2 is landline, 3 is cable, and satellite is the bottom at 8%. So though you're bringing up the satellite rate more than you're bringing the wireless rate down, the base is bigger on the wireless and you're not accounting for the whole revenue loss. This is different from Virginia. Virginia pre-reform had landline tax at a greater rate than wireless, and the reform actually brought the wireless rate up. Next slide, please. So I think that's essentially, hopefully, covered the first point about the effective rates being replaced in Maryland are higher than in Virginia. Now the second point about the diminishing significantly over time. Next slide, please. Virginia's revenue is expected to diminish because, as I've said, wireless was taxed at a lower rate than landline. At the time, they were thinking, and I haven't studied how much this happened, but the idea was people were going to switch from landline and they were going to go to wireless. They're going to give up their landlines and go over. That means that the tax rate, they're going to a lower tax rate from a higher tax rate. So 5 years down the line, you're talking about automatically they're expecting this much more revenue lost. This is different from Maryland. Our wireless rate is higher. So if this does happen, we'll actually be seeing more revenue. This is a reliable diminishing factor that they could conclude about. For us, the base could change over time, but because of some unknowns, it's hard to tell where it's going to. Particularly, the two unknowns are the adoption rate of new technologies, as well as the outcome of certain federal factors which could affect our taxable base. But one of the new technologies we've talked about a lot has been internet stream television. The fear here is that people are going to switch from their traditional cable television and go over internet stream television, which would mean that the local governments, which are taxing the cable now, would lose money. Additionally, the state doesn't codify that these services are taxable. So that's a revenue loss. It's just not taxable. And the reason, though, that the adoption rate is kind of uncertain at the moment is, for a long time, we've been thinking this is the new thing. It's going to take over. It's the rate. Some people have said it's going to be very fast takeover. Some people said slow. It differs your opinion. And what has happened has been pretty slow pickup. However, to try to account for this, they keep changing their methods of attracting consumers. Something they've done recently is do exclusive rights to viewing channels that regular pay television cable does not have. So things like Netflix now are exclusively buying Arrested Development, House of Cards. Amazon Prime is now going to be the sole providers of Alka House. It's a show I'm interested in. It's not out yet. But the idea is, before you could view it on internet stream TV, you could view these television shows, but a couple days after they came on the regular pay television. Now the only real way to see it will be on these internet streams. Could pick up fast, could not. It's too early to know. Another issue with the revenue collection from these internet streams services are federal issues. Currently, the Supreme Court has determined that the only Congress can require remote sellers to collect the sales tax for states in which they do not have a physical presence. Many of the providers of these new technologies do not have physical presence in the state. As a result, unless Congress overturns this prohibition, Maryland will not receive much of these revenues, even if we codify these internet streaming services, the other over-the-top services, as taxable. The Marketplace Fairness Act has recently passed the Senate. It's in the House. The fate remains uncertain until the state is allowed to obligate sellers to collect the sales tax. Much of these revenues would be gone even if we codify it as taxable. Another thing that could affect the taxable base in the future, that is a federal issue that we are not aware of yet, is the federal prohibition from taxing internet access, known as the Internet Tax Moratorium. It's set to expire in 2014. It's been extended many times, but if it expires, the revenue base may increase substantially, notably wireless data plans. They are not taxable now because that's considered data access. It could be that these are instantaneously part of the sales tax if this prohibition goes away, and other taxable base reasons there. Next slide. But in conclusion, to enact these reforms, what we would need to do is do a higher combined state and local sales tax rate than the 6% proposed and higher than the 5% of Virginia. Also, another conclusion is that forecasting the rate forward is difficult at this time. A lot of things could change in the coming years that could significantly change the revenues under any proposal, current, future. Thank you.
Okay. All right, from there, we are going to open up for, I think we have 2 5-minute presentations. Andrew Reinsdorf, I think, has one, and Mitsuko Herrera has the second one. So Andrew, you want to go first?
Sure, that's okay. If it's okay, I'll just speak from my desk.
Go right ahead.
And I won't take all 5 minutes. I was fortunate enough to give a PowerPoint, I think, the last meeting before that. So really just to summarize that and to start out and first say to the chair and to all of the folks present who have come, we appreciate the opportunity to share Satellite's views on this. The satellite industry has 430,000 subscribers in the state of Maryland, and we offer a video service. We come through the federal airways to private residents. We don't have franchise agreements because we don't use public rights of way. And consequently, we don't sell high-speed data that our friends and sometimes partners, AT&T, Verizon, and cable companies do, and we don't sell a telephone product. And frankly, we're envious of that pipe that our competitors have into the home. And that pipe is why, in large part, we think that they still have 75% of the market, and we only have 25% of the market. In the state of Maryland, only 1 out of 4 people who pay for television take it from 2 companies, DirecTV and Dish. And I think that's an important distinction as well. No matter where you live in the state of Maryland and the United States, you always have a choice between 2 different satellite providers, so long as you have a view of the southern sky. And we think that makes us better, but we still have to go up against a very significant structural advantage as we compete with companies that have that pipe and sell 3 services. Now, to get that pipe, those companies negotiate with localities. Mitzi can speak to this with much greater authority than I. Like places like Montgomery County, and they have a federally capped franchise fee that they have to pay. I asserted that in the PowerPoint presentation that the truth is in the name. It's called a fee for a reason, right? Because they get something of tremendous value. Comcast on their filings with the SEC values their franchise agreements in the billions of dollars. We understand that the profit margins on their data product that they get as a result of that franchise fee are north of net 50%. As I said, we're envious. We'd love to pay their franchise fees if we could have that broadband product, but we don't. They have a structural advantage, and they are to be commended, and they've spent billions of dollars on that plant and that infrastructure. We do our best through customer service. We do our best through programming to try to compete and to offer everybody in Maryland and everybody in the country a competitive alternative. But to argue that because they pay a franchise fee, a satellite subscriber should somehow pay a higher sales tax, and that's what Proposal 1 does, right? Proposal 1 gets rid of the franchise fee, conflates it, we think, wrongly into a tax, and it says to satellite subscribers in Maryland, for choosing an alternative to cable, you're going to now subsidize their cost of doing business. We don't think this is a cost of doing business reform commission. We think it's a tax reform commission. Thus, we don't think franchise fees have any place in the debate and in the conclusions of the recommendations. So no surprise, as we were when I presented, Proposition 1 or Proposal 1 is not acceptable to us, and we steadfastly oppose it. You saw on that chart on there what happened to our costs. And another thing happens when our costs go up, as was the case in Virginia. The revenue that's predicted from satellite subscribers never comes in as it's predicted. Because if all of a sudden, someone who's living in rural Maryland who's chosen satellite all of a sudden has a 7% increase on their bill, they spend less on their package, or they leave us and go to a competitor, or they go to Netflix. To talk a little bit about Netflix. Netflix is the largest pay-TV provider in the country right now, and they don't have any taxes. But wait for them. But they have 30 million subscribers, and they provide a choice, an increasingly competitive alternative. So if you artificially raise our taxes to pay for the cost of doing business for our competitors, franchise fee, we think that that's not a good idea. But again, we're grateful to be here, happy to have a discussion, and glad to be a part of the debate.
Thank you. Appreciate that. Okay, Mitzi is not presenting today. Kathy and Sue Ellen are going
No.
to.
I am. Kathy's late, so I'm going to just try to cover both of them, and then Sue Ellen is also.
Okay.
Sorry.
Okay.
Okay, so. Okay, so if I could get in the packet here, if you could actually just turn to the, it's one that says page 2 of the charts. I think that maybe this could get to it. What Kathy was going to talk about is that the local government proposals put forward 6 principles. Those are on the first page. And the main thing, the number one thing, is that the tax reform structure should work so that the local governments do not have a negative fiscal impact, and that the tax structure should be broad enough that as people switch services and technology changes, you're able to capture those without having to come back and look at constantly new legislation. So what we did is, if you take a look at this chart, is these are the state numbers from proposal, just ignore the information analysis at this point. The proposal 1 and proposal 2. What we did is we separated out of the changes in those proposals, which ones affect the taxes collected by the state and which ones affect the taxes collected by the local governments. And you'll see there that it says total local impact. The problem on the proposal 1 and proposal 2 is that the local governments lose between somewhere of 137 million and 141 million. And if you look above it, there's not enough new revenue coming into the state to offset that. So it would either mean that under either proposal that the local governments would have a significant revenue loss, and that the state would either have to say that we're going to reform taxes and the state would take less in order to make those local governments whole, or the local governments would still have a shortfall. So that, I think, was really the primary point of what Kathleen was going to talk about. The other key point is that what's very important for local governments is the ability to say, yes, we want taxes, or no, we don't. And the problem with trying to come up with a proposal which implements something on a statewide level is that for localities that didn't have taxes, they would end up having to have them if they're not necessarily getting in new revenue, because you're trying to make the other ones who had revenue whole. So one of the things that we strongly advocate is the ability to have something at the local level. Now, if I can turn your attention to the sheet of paper that Nick just passed out, what I'm looking for in a proposal today is to try to get consensus. I've had conversations with staff to ask for some additional data, which I think that the staff can calculate based on the data that we've already collected. And I guess as any parent of a teenager would know, when a kid asks you if you can have something, the first thing you ask is, well, what's it cost? And what we'd like to do is, in order to really figure out and find some consensus, is to figure out, by drilling down a little bit more in the data, of what would these things run. So what I tried to do is, if you look in those questions, the overarching question is, if you broaden the tax base, is there a way to say that everybody could be charged the same thing and ultimately have it be at a lower level? So one way to do that is to separate out, let's look at what the state is collecting, and then let's look separately at what the locals are collecting. So the first item that you'll see there is, I think that these are going through the information provided by the state. Those are all the taxes that are levied on telecom services. So the question for the state would be, if you wanted to replace all those taxes and be revenue neutral, what is the single rate that you have to come up with? Alternatively, at the state level, if you pulled in all the telecom taxes and all the video taxes and communications that the state's levying now, and you wanted to replace those with a single rate that applied to all those industries, what would that rate be? And hopefully, that rate would be lower than if you only charged it on telecom providers, based on the way that the taxes are being collected now. If we had that information, then we would at least sort of have a tipping point in which you know, at this rate, based on this tax level, this is where you gain revenue and this is where you lose revenue. Then I ask those same questions at the local level. The concern at the local level is that, and this I am speaking as the cable administrator for Montgomery County, cable broadband administrator, and I have a responsibility to do fiscal projections out for those revenues. So this is not a proposal from MACO, it's not a proposal from Montgomery County, it's not an MML proposal. But in looking at the local levels, right now, half the revenue coming into locals is coming from the tax on telecom services. And because of the way state law is written, there are only 5 counties that are able to collect them. And because of the way state law is written, we collect them in different formats. So what we're looking for, and you can see in the next few questions, is just to get some additional data, which I think the state has right now, so that we can understand what that impact is. Question 6, you'll see, is to, I think again, the state has this data, is to figure out what are the revenues earned by each industry, and I think that there's a way that they can give an estimate of that based on the data that they've got, so that then we could look, and I'm hoping that the data will only take maybe like a week or so to pull together, so that in terms of moving forward as a consensus, if we had better drill down analysis of what the fiscal impact of that would be, we would have a way forward. The other ones that are listed on there is asking, can you break out that information by county? What we're looking, the other piece of information when I tried to run some of these numbers is at the local government level, not all localities collect telecom taxes and not all of them collect franchise fees. So if you knew what percentage of the total revenue in the state was being subject to local taxes or local franchising fees now, then you would have a better way of estimating as a tax yield if we assume that only the jurisdictions that are currently imposing those charges charge it going forward. You'd better be able to understand this. And the last piece that we ask is, in terms of equity, and we agree with the satellite industries that there's a difference between taxes and fees, that and the right-of-way users, what would happen if you treated all right-of-way users the same, similar to you taxed all communications providers the same. So for the right-of-way, instead of having fees that are primarily imposed just on cable service, what if those same fees are, the same rates apply to wireline telephone and potentially wireline broadband? And the broadband, I think, is very important because one of the things that we learned in this commission from the presentations by industry is that broadband is the future. There are more and more services in which people are moving from a landline to a mobile to a wireless data. They are moving from necessarily maybe having a video service to a satellite service. And so if you had a broader base, which had the same rate,
need you to wrap up.
then yes, if you had a broader base that had the same rate, then you would be able to, people could shift technologies and you wouldn't have a change or a big impact on your tax base. So I thank you for the time and I thank you for
Thank you.
the opportunity.
Okay, what I'd like to do now is just kind of open this up for discussion, and
Right, Chair, if I may just take 45 seconds?
sure, go ahead.
I'm sorry. Any information that was requested, we would also appreciate on the municipal level. I'm speaking for MML. You have our presentation today. I won't read it to you. The two most important things we think are that we presented you with proposal or principles in December, the local government principles. We would like whatever analysis is taken up and completed to be relevant to that and show how those principles are supported or are not supported. And the second thing is that in further information that we think would be useful, we would be requesting further analysis about the impact of exempting federal lifeline and other low-income service programs from state taxation. So those are the 2 high points, but all these points are made on our submission to date. Thank you.
Okay, thank you. What I'd like to do now is open this up for discussion, and I want to try and keep this as balanced as we can, and so that it's not weighted down with one person talking longer than others, and I just want everybody to get a decent amount of time to express their opinions. So any findings that appear to have considerable support from the commission members will be included in the final report. So really, we just want to have a good discussion here this afternoon. So, who would like to start off? Anybody? Go ahead.
Senator King, just kind of I think you said, are you planning to have final decision made by this meeting today, or, I think there's still one meeting on schedule.
I'm guessing that we're probably going to have one more meeting to wrap this up, yes.
Just looking at the numbers, I mean, for the proposal we had put forward, the numbers didn't come out exactly how we wanted them to, but we still think we can come up with a plan that would be more revenue neutral. It might work for everybody. Listen to David's presentation, I think what I kind of got out of it, and he's exactly right about who knows what's going to happen in the future? You know, what's going to happen with the Internet Tax Freedom Act, the Marketplace Fairness Act, is that going to get enacted? What's going to happen with Netflix? And what that tells me is, in trying to tax telecommunications service in the future, can't like say, okay, you know, try to pick what horse you're going to back, because you don't know which way it's going to go. And I think that's what Maryland, and frankly, a lot of states, that's how their policies are currently. They're trying to say, okay, this is where we think our revenues come from. We're going to tax this one versus that one. And that's why our proposal is more like, you know, let's spread it out where we're taxing everybody the same. And then whichever one happens to be the one that comes forward and is the main service in the future, you're going to still get your revenue.
Right. I think it's coming from the Budget and Tax Committee and listening to Sheila Hickson from the Ways and Means Committee. And Sheila has been on the NCSL committee looking at this sales tax issue for a lot of years. And because it has changed so rapidly, it has been very hard for the national organization to come up with a recommendation on it. And I'm hoping that we're able to, but I'm not, you know, I just will wait and see what happens. Yes.
Just a question, and maybe what I'm missing. I spent a lot of time over the last couple of months trying to look at my telephone bill, my wireless bill, my friend's Comcast bill, just to try and understand what the taxes and it's very confusing. I guess the question is, in these proposals, how much of them are automatic pass-throughs, and how much would impact the consumer? So does this mean that the consumer who lives in a non-Montgomery, Prince George County phone bill will go up? I mean, I don't get a sense of, I get a sense of the revenue, but I don't get a sense, A, how much of this goes automatically to the consumer, and how does this impact the consumer's bill? I don't know if it's possible to generate some information on that, but that's one thing, you know, as a person who represents working people, you know, who would be interested in just knowing how will this impact my bill?
There's a table in the report.
Well, that's how much it affects the, I guess the question is, if I have I mean, that's the revenue, does that mean that I guess I'm trying to understand, does that mean if I live in, I don't know, Caroline County, my tax on my bill will go up to that amount? Is that what that means?
Which page are you on? Are you on
So I'm
17?
17 is what I thought,
Yeah.
no,
So,
16.
Jump to 17.
Okay.
That's the most effective way to communicate this. On page 17, you know, it shows some assumptions we made to look at and what we characterize as a household here. Landline phone account for $30 a month. 3 cell phones on a family plan for $50 a month, and that's just the talk piece, that's not the data. And 1 basic television plan for $50 a month. And you can see the current, whether you have cable or satellite, what the effective tax rate would be for all of those services combined. And then proposal 1 or 2. So for someone in Caroline County, they could see an increase in the effective tax rate requirement.
And is every tax completely passed through? I mean, is there any of it in terms of, you know, profit or, you know, I mean, is everything we ever do immediately passed to the customer?
These are generally directly collected from the customer and then remitted to the state or local government.
Okay, so that's on anything we would do would be automatically on the customer's bill, what you say, even the corporate income tax. And one last question is, I guess my concern is in Montgomery County, for whatever reason, in Prince George where I live, the government has decided, and people are used to a certain amount of tax on their fee. So you're saying that the state would then we would then cut their costs on their phone bill, even though the local government has decided that it's a higher level.
In
Prince George County, it's like 12.6%, right?
Right.
And under the way I read under number 1, it would go down to 6.7%.
That's right. That's one thing that made the proposals very difficult to work, as David mentioned, it's the way that things are taxed currently, and also the fact that the counties that do have these are the most populated counties in the state. So you're talking about a significant number of households relative to the
So wouldn't that might be a tax shift, I guess, from one part of the community to another part of the community? I mean, that we would basically be shifting taxes away from certain counties onto other counties. Is that a ramification of this?
I think that's what the chart shows.
Andy, while we're on, if I may, Madam Chairman, while we're on page 16, appendix 9, we've got Washington County, Worcester County, Dorchester County that have no, I guess we have no franchise fees, actually thought there was more, and that would continue under proposal 1 to have no set new sales tax? Am I reading that wrong?
They don't have cable. They don't have cable franchise in Washington County.
There's no cable subscribers at all in those 3 counties?
Actually, we have a few.
Yeah, that can't be.
Okay, we may have some bad data there.
Right, so they would presumably going from 0, right? Just like satellite, they would be going from 0, a rural cable subscriber in the counties that don't have franchise fees, just so everybody's
Right.
benefit, would go from 0 sales tax to 6.7. So it wouldn't only be an increase in our 430,000 homes, it would be an increase on the people who have chosen rural cable and don't have franchise fees. Under proposal 1, just as a point of clarification.
David, it's a few of the cities that do general. They could have a franchise fee.
Yes, Doug?
Forgive me if I'm asking questions that already been covered, and I apologize for having missed the meeting. I'm interested in the presentation today in comparison to Virginia. And a few years ago, when some legislation was brought up, there was a comparison to Virginia again. And I'm just wondering why staff chose just Virginia for comparison, why no other states such as Florida?
Virginia was brought up quite a bit in the discussions for the bill that created the commission, and Maryland is generally very interested in Virginia, I would say.
I understand that from perhaps a legislative standpoint, but from a thorough research.
The staff report, so it was the angle we chose to take.
I guess I'm listening to him. Why haven't we, why are we just looking at Virginia?
Well, we did look at what other states have done. We compared what was presented to Virginia. I think it most closely lined up with what Virginia had done, which was kind of well-informed.
I know that's what we wanted. You know, I know they were first to kind of do it and get it done, and we wanted to kind of look at that model. But are there any other states trying to do what Virginia has done other than us? Do you know?
I haven't checked in to see what Delaware is. I think Delaware had a commission.
Yeah, they're sort of on hiatus right now, but they still have an ongoing commission.
Yeah.
Yeah, I'm on that tax commission as well, and they're on hiatus. No one has replicated the Virginia model since it was, in our view, foisted upon them.
North Carolina came close.
That was before Virginia.
That was before Virginia.
No, since Virginia, no one has replicated it. And in fact, North Carolina and Virginia, you have municipalities now suing the state over the model because they're getting less revenue.
If I could ask one question in terms of, I understand the revenue perspective and the intent. The affiliated small business impact that also are part of the distribution of these services and the potential impact on their competitive environment and our small business environment, is that consideration folded into any study, any approach as to what that impact might be?
We didn't analyze small business specifically. Their revenues are folded into here to the extent that they are taxed.
I understand, but on the revenue side, it's counted of what's the impact on local small businesses within our community. Are there impacts, and are those impacts negative, and should we consider that as a part of the consideration?
And I think you could probably look at them in similar context to page 17, depending where they are, they would likely see tax rate changes, either up or down.
work with that.
But we did not analyze that specifically in the report.
Yes.
I'm Scott Mackey, representing the wireless industry, and I'm the one who put the two proposals on the table. I just want to commend the staff for the way you presented the information today. I mean, I think there's some fairly stark issues in here for the state to consider. I mean, we knew when we proposed this reform that there was going to be some huge challenges in Maryland that weren't present in Virginia and other states, just because of the significant divergence in what different localities are getting. And I mean, if you look at page 18 of the staff report, in 3 counties, the representative household is paying almost $200 a year in taxes on their communications services, and then you look at some of the other counties and they're paying, it looks like around $15. So if we're going to tackle local taxes in the state of Maryland, there's going to be this problem of winners and losers, and it's going to be very, very challenging and difficult to deal with. We knew that going in. But on the other hand, you know, if you look at the current structure, it's the wireless consumer that is disproportionately paying a lot of taxes to the state and its localities. I think the chart that you showed where the DirecTV subscriber portion of the base was only 8%, where wireless was nearly 40% of all the revenues that are being collected. So clearly we have an interest in looking at tax reform globally and trying to figure out if we can't come up with a fairer way, notwithstanding some of the local government challenges. And, you know, I guess what I'd like to say to the commission is that, you know, we had hoped that the numbers would have come in closer to revenue neutral than they did. I think we had underestimated how much shifting from a gross receipts tax, which could be surcharged onto governmental and nonprofits and collected from them, as opposed to a sales tax where those entities are statutorily exempt, was going to affect how much additional revenue would come in from moving the rate from 2% to 6%. But I guess what I'd like to suggest is that, you know, now that we've got these numbers, we'd like a little bit more time to see if we can't tweak this. Maybe the thing to do is start with the state piece first and see, are there things that we can do just with the state revenue piece that could move toward a better system, a fairer system, recognizing that the local piece is a much bigger problem and a much bigger issue to solve, but one that would continue to need to be worked on. So I guess what I'm saying to fellow commissioners is we'd like a little, if we could just have a little time to digest this, see if maybe we could tweak the proposals in a way where maybe we could start with some state level reforms, but continue to look at ways, maybe with some of the new data that is being requested from the staff, if it can be gathered from them without a lot of new expense and without sending the survey to 1,100 businesses again. Maybe we can get a head start on some of the state issues and then, you know, I hate to say defer, but, you know, continue to look at the local issues, because we really think, you know, the information that's been gathered and presented is excellent. There's some things that we could do to get started. And so hopefully we'd like a little more time to maybe modify some of the proposals that we'd made initially and see whether there's something that might be acceptable to the majority of the commission, maybe even between now and our next meeting, that we could look at and vote on. Clearly we're not going to solve the entire issue given the financial implications right now. So thank you.
I agree with what you're saying, and I think our committees are really looking for some guidance, just like you're talking about. We have, the legislation said that we have to have this report finished by or this commission finished by June 30th. So we have one more meeting that's on the schedule for June. If we can get some of that pulled together for that meeting, in order to just bring those recommendations to the committees, I think it would be very, very helpful.
I'll point out that I think that would mean that if there was going to be a vote, members would have to vote at the meeting where that's being discussed. So you'd be making the recommendation on the same day that you'd be voting on it. I know many people need to talk about votes. And I'll say with regard to the data, some of the things that we disseminate what we could. As we get more granular, disclosure issues become apparent. And especially when we start looking at county level information, we can't put a lot of things out there. We were very careful to review all this and make sure, even if you're looking at page 18 and page 14, you can't combine them to get to something that folks don't want to see. We need to be cautious there, I'll say, in what we can get out. And for the data that we don't have, that we weren't able to ask for because of the statute, obviously we can work up estimates. It would be an estimated process.
But the way if we did develop another plan, we could send it to you, and you could distribute it to the commission prior to the next meeting, so people would have time to digest it.
Yeah, I think we can do that, as long as we're mindful of, if we get 500 plans.
I'm not guessing that we will, and I think if we could do that within the next couple of weeks, so that people have a chance to get opinions from wherever they need to get opinions, so that they're ready to come and actually vote as a commission member at the next meeting. Will that work for people, for everybody?
Yeah, assuming any plan is going to be probably less complex, more complex than we did already, so probably simpler.
Right.
So just for clarification, on when I started putting forward on the data, it was in trying to figure out what the fiscal impact was, is sort of understanding that if the staff, from conversations, I think is data that they have available, is there a way that we could get that so that we could actually sort of internally look at different calculations?
I think you can generally get to all the data that we have through these charts. There's like a specific bar chart that has a dollar amount. We can probably get you that dollar amount, so it's more specific. Getting more granular, for instance, we lump the telecom together. If you start looking at breaking that out between wireless and landline, there's going to be disclosure issues.
So I guess then for clarification, in the handout that I gave, in asking the state, is it possible for the state to take all the telecom taxes that are paid, if you're only looking at the state, and to come up with what the rate would have to be to recover all of that? Can you do that relatively simply?
Yeah, for all of the state taxes.
Yeah.
Currently. So
And then
all
can
of
you-
the state ones we've talked about, they're in proposal to come up with a rate, one rate that would get that same amount of revenue.
Right, because that would kind of give us a baseline of where you know above this you lose money, above this there's more revenue coming in that may offset. Same thing if you covered all the state video and telecom taxes and you spread it out over all those industries, the presumption is that that rate would be lower than if you only charged it on telecom. So that's what we were looking to get at. The other, I think, the big piece is on page 8, or I'm sorry, on question 8, is that it's very difficult at the local level to understand what the impact is without understanding. We can back out of your data and guess and make an estimate at what some of the gross revenues are. But what we don't know is how much of those revenues are subject to taxation at the local level. And so one thing I'd point out is the chart, which I think, and again, I think the work that you did, we've had conversations, is fabulous.
Thank you.
I mean, if you like numbers, it's chock full of great information. But for example, in Appendix 5, which lists the local government communications revenue, is it possible for you just to give us the numbers that you used to create that chart?
Yes.
So, and that's really, I think in the information request that I had given to you, is to basically figure out is can you, recognizing if you can't do something because of confidentiality, to be able to provide us with that data. So one is, particularly at the local level, if we can figure out what is the impact. And frankly, even at the local level, it is varies county by county, and the ability to get agreement, really, in each county, they're gonna ask, well, what's it do for us?
Yeah, we'll take a look at 12, and I'll make sure that that doesn't violate any other issues, but
In the presentation, I keep seeing just the term revenue. And if we move to a statewide model, is the assumption that the statewide is also, then if it's going to receive more revenue, is it also going to provide the services that the local governments are providing? And if so, what are the expenses that the state is going to incur that would offset some of that revenue? Who is going to handle complaints? Who is going to manage the right-of-way? Who's going to go out and check on permits? Who's going to respond to Nancy King when somebody's digging up her front yard? Is it going to be somebody sitting here in Annapolis, or is it going to be somebody in Mitzi's office or my office? Have expenses been accounted for anywhere along the line in any type of statewide revenue model?
No, we were only charged with looking at tax reform.
How can you look at tax reform and get a total picture if you're only looking at half the scale? The scale is both revenue and expenses. And you're looking at a gross rather than a net.
I think we're following the scope of the statute. I don't know what else to tell you, and those weren't included as part of the proposals.
I mean, we've gone outside since the first meeting, and I hate to be negative about this, but since the first meeting, we've gone outside the statute when we started talking about franchise fees and peg fees that were intentionally taken out of the legislation. So I'm wondering, how are these decisions being made?
So you're recommending that we start examining local expenditures? Part of it?
Well, is the state going to be taking over those duties, and is it going to have an effect on the total state revenue?
So we should look at what's being spent and see if we need all that revenue to cover it?
And who's going to do it under the proposal?
Gary Lindsay with AT&T. I think one of the things that part of this discussion in my mind was an intent in any thing that we might propose that there would be a concept of revenue neutrality such that there wouldn't be a question of trying to take money away necessarily from a particular jurisdiction. There would be a way to try to make that revenue neutral, in a given proposal. So I'm not sure. And I think that would still be in the spirit of what we're talking about, that would be preserved. It would seem very unlikely to come up with a proposal that would then take money from one county
That would be a key element for us, is that if it is revenue neutral for us as a municipality, so that we can keep providing those services.
Right. I think if there was a discussion, and wanted to be a discussion about costs, that would kind of be another discussion. This is kind of containing or dealing with the revenue lay of the land as it is, and how might we reform it in such a way that it will ultimately be revenue neutral.
John, do you have a comment?
Yeah, if I may, thank you, Senator. Just a couple of things. First, I think the staff report is outstanding. I mean, it really is a great neutral lay of the land, and it's really, I think I read it twice just to make sure I got it right. I mean, it's a nice report, so I really do appreciate the work that's gone into this. I think that the efforts of this commission are well intended, and if we do come out of it with just a great understanding of who's paying what, when, and where, we've done a lot. Because I know I've been involved with this issue back and forth every now and then for the last 12 or 14 years, and no one's ever captured it in a great way, in my opinion. Having said that, just a couple of things I have to note. I mean, Mr. Reisendorf makes a very compelling and a nice, passionate argument on franchise fees. I, of course, have to respectfully disagree. I'm not going to have the whole hash out again. We did that at the last meeting. There's no reason to go into all that. But certainly, those of us who are paying that fee view that as a tax, with all due respect to the localities. Some differences of opinions there, and you just need to be aware of that as we do it. I'm also thankful the staff is respectful of the confidentiality, or the need to safeguard the confidentiality on the revenues. Was a little concerned. I think Mitzi makes some excellent points, or I should say the localities in general, but I think Mitzi Grant is a good spokesman for that on the additional information. We get a little nervous when we start seeing revenue broken out by more granular, because we become bigger fishes in those smaller ponds. And I think there's several at the table that share that concern, so we're very thankful to hear that echoed. I do think that it makes sense going forward to get some more detailed proposals on the table. And I think that's the right way to go. It does feel like we've done a lot of really good work It does feel like we might be leaving some things on the table as we leave this because of the timeframes, but it does feel like this is just a great effort moving forward.
Doug brings up some good points. I think it dovetails with what was raised earlier today by Minister Mackey, which is that the localities present a larger problem in terms of disparities and the things that you have to deal with. I thought we were going to be going forward possibly and looking at a state level first. And that's what we'd be looking to come in terms of the proposal. And maybe later dealing with the thornier issues that were just raised today and have been over time. But if we're going to be looking at a state level kind of concept, then the questions that Doug's been raising this afternoon would be something we might look at later, but don't have to look at right now.
Just very briefly, Doug, I just wanted to point out that in our proposal, in Proposal 1, the municipalities and the counties were going to continue to be able to get the franchisees they were getting today, and there would be a credit against that. So our Proposal 1 was not proposing to take the money, give it to the state, and then have them distribute it back. The revenues that are coming from wireless, in my understanding, have nothing to do with the management of the right-of-way. They're general fund revenues that localities are using. Wireless is not in the right-of-way. And so the excess revenues that are coming into localities that we would be proposing to scale back have nothing to do with anything related to the right-of-way. And so in Proposal 1, we proposed to keep those revenues flowing to the locals, and in Proposal 2, we only addressed telecom. So to your specific point, at least for the proposals that I made on behalf of the wireless industry, I don't think anybody was proposing to take at the state level the revenues and that are linked to the responsibilities that you have for the right-of-way. Just wanted to put that on the record.
Just a question about that. Well, I understand what you're saying about the revenues going back to municipalities. When the broadband-based tax bill still hit the person differentially. So let's say, would it be taxed differently? So if I live right now in Frederick County versus Montgomery County, the revenues would go back to Montgomery, Prince George, but taking the revenue from the consumer, would that also be done county by county, and how would you do that differently? Or would they get a credit? That I don't understand. In other words, I understand maybe giving the county, but I don't understand how you would get the revenue from it if it's a broad base. Am I making myself clear?
I think so. I wasn't very.
So, if I live in Montgomery County, you're saying that the idea with the government would still get the same amount of revenue, right? But if I'm a Comcast subscriber, would my bill change? Because on this thing, my bill would go down. My bill from, some other county would go up. Would that also change, or is it just, besides that?
Under the first proposal, most of the reduction would be due to the fact that your wireless taxes would go down. And if you were a satellite subscriber, your taxes would go up because you're not paying anything now. So the difference in Montgomery under Proposal 1 would be wireless taxes come way down, satellite taxes come up, and that was what James, I think it was, mentioned during his presentation. If you were a cable TV subscriber, then it would be roughly the same, but your wireless taxes would come down. That's under Proposal 1. Under Proposal 2, we left sort of the video out altogether, and so the difference would be in Montgomery, it would be solely on the wireless taxes. If you were a wireless customer in a county that doesn't have it, if not one of these 5 counties that does the extra add-on wireless taxes, you would see no change in your bill other than the lowering of your wireless taxes. So there would be some higher taxes if you were in a rural county under our first proposal and you had DirecTV or Dish, and you weren't paying an add-on wireless tax now, you would see an increase in your taxes. in those counties under the first proposal. Under the second proposal, I believe there'd be no change.
Can I just put a finer point on that? What you're saying, though, is that in the 5 counties that collect local telecom taxes, those would be eliminated. And they already collect franchise fees, so there's no new revenue happening there. And I think it kind of gets to the point that we've sort of said, is that addressing the local issue is going to take more work as opposed, but it could be a clear path forward. On the state level, I will say that from the first report that we had in October, I mean, I had to call Laura Keeley yesterday because I didn't understand on the property tax valuations and various other things in there. We have a soup of different taxes at different rates levied on services which are becoming more and more fungible that's solely collected at the state level. And there is an opportunity that, and which is the first 2 questions that I looked at, there really is an opportunity for us to say, if we focused on the state, what would be the single rate that you have to have so that all those services could be taxed the same? It wouldn't matter whether you are a tariff service or not, or VIP, and when you switch between them. And it would be a simpler, equitable, and the reason I asked the state staff to come up with what that rate is then you would know at that rate that this is revenue neutral, which meets a lot of the criteria that we were looking for. And then you'd have the ability to look at, because it's worth noting as well, that because of the statutes, which these reports haven't looked at all, because of the statutes that limit the authority of what local governments can or cannot do, just because there's 5 counties that have ability to tax now doesn't mean that other counties wouldn't necessarily do it. There are some counties, even if they have the authority, they still want, and cities that still want the authority not to have to tax. And I just think that there are constitutional issues. It's just a much more complicated, and frankly, it's the thing that's driving the big hole in the picture is how you account for those. And so starting with the state first may be a good way to go about doing it.
Just one statement of fact, and we'll support this with a document that we to the committee that it's our understanding, and we'll document this, that in Virginia and North Carolina that have adopted really the model that is Proposal 1, municipalities receive 25% less money than they had prior, and we'll document that. And then just 2 quick questions for Scott, because he's the author and the proponent of Proposal 1. One, does our shared competitors, Netflix and Hulu Plus and all the new internet TV providers, what does their new tax go from? You're proposing to raise satellites from 0 to 7%, although we do pay some taxes on business purposes and on pay-per-view movies, what have you, so it's not quite 0. But what do Netflix and Hulu? Netflix now has 30 million subs in Maryland. What happens to those homes? And then 2, is it fair to say, or would you disagree, we can disagree over the value of franchise fees and why they're called fees and not taxes, but do you disagree that the new tax on the 430,000 Maryland homes that you're advocating for, is that going to go to offset the lost revenue from taking franchise fees out in Proposal 1? So 2 questions, one on Netflix, one on the new tax that you're proposing on 430,000 Maryland families. Does that go to subsidize the lost revenue from franchise fees being taken out in Proposal 1?
So on your first question, we didn't really address Netflix. I don't know, is that currently considered a rental under Maryland statute, or is Netflix?
Delivered streaming would be a digital good. It's a subscription service that's received digitally, so there's no tangible product, and it wouldn't be taxable.
Okay. So our proposal was silent on it.
So I'm just on that point, though, it's coming through the pipe, the cable pipe, to a home, right? We're a digital good coming through the federal airways to a home, so why are we tangible and they're not? We're not even coming through a local asset like they are, like Netflix is, right? They're coming on the Fios pipe, the Comcast pipe.
You're currently not taxable either.
What's that?
You're currently not taxable either. Your base service, certain services are specifically listed that you provide that are taxable, pay-per-view and wrestling.
But
I believe that's it. But your base service is not taxable.
Right.
Just like Netflix is.
The second question, if I understand it right, is I think under our Proposal 1, what we were saying is that the municipalities would continue to get their 5% franchise fees and up to 1% PEG fees, and the rate would be 6. So I'm not sure what we're supposed to be subsidizing with what we propose. They're continuing to get those under our proposal.
So where does our 7%, where does the new revenue generated from taxing satellite subscribers at 7%, where does that go? Who gets that?
The state gets it.
Right, but what is it offsetting? If you're not revenue neutral in this proposal, right, you're losing money, but you're taxing 430,000 new homes, right? That's got to be a new revenue pie, right? We can all agree on that.
Whatever the number
So
was,
where
27
is,
million.
who's getting taxed less because satellite's getting taxed more?
Well, I mean, we didn't talk about revenue sharing component, but wireless. I mean, wireless, if you looked at the effective rates, we're paying, I forget what the number was, 12, 11, 10%, and you're paying 0. So in our concept, the effective rates on wireless customers would come down.
Does DirecTV compete with Verizon Wireless?
It doesn't have anything to do with competing with each other.
Exactly, so why should we pay to lower your taxes?
I mean, the point of this Communications Tax Reform Commission was to come up with a fair communications tax structure. And I believe that's what our proposal does. Now, there are going to be winners and losers just within local governments under our proposal. I think we recognize that all along. But we believe, based on what other states have done, and based on the fact that, in my opinion, the consumers of wireless services are paying a disproportionate share of the tax burden today. And so it was my feeling and our feeling that the proposal would create a fairer system. We never claimed there wouldn't be winners and losers.
Yes, to kind of continue the conversation that Mr. Mackey was bringing forward. You know, in looking at this reform, I happened to look back at some of the earlier reports on on reform, and you know, years ago there was speculation on what was going to happen with long distance. I think the presentation that was done today is very useful when you look at the you know, kind of the spectrum of services that are out there that we're trying to get our hands around what is communication service. And I think the focus of this commission is not necessarily looking at whose costs, whether something is a fee and whether something is covering someone's cost. We're looking at the revenue and what would be a fair taxation on the consumer. And the fact, as Mr. Mackey mentions, that the wireless consumers wireless is fairly ubiquitous now, so we're saying that the citizens of Maryland are paying a pretty high tax on wireless compared to other goods and services in the state. So I think, you know, my focus is also looking on the impact on the consumer and thinking, you know, a state can decide to tax clothing, they can decide to tax services, they can, you know, legislatively. And in looking at the mix of services that are here and things like Hulu, I think it's important to focus back on the consumer and say what's fair, you know, across the board in this context. Whether it's satellite, whether it's wireless, but again, what does the state want to, what tax does the state want to apply to its consumers?
Yes. On that point about consumers, there's been several discussions on that and the issues. I too, as a bean counter, appreciate and compliment the analysis that staff has done. It's terrific. It's shown us a lot. On the points about the consumers and where the revenue is currently coming from, let's also focus that it's not only on homes, but it's also on businesses. And Maryland is already known as one of the top 10 most expensive places to do business. So dealing with the fairness, the higher equity in spreading these taxes around, let's remember that businesses are also significant consumers of a lot of the services that we're talking about here.
Yes. As we were talking about introducing a different version of proposals, want to make sure that we're clear that we will be talking about on in appendix 2 on page 9, the state revenue level, which is 683 million. And with you leaving the local revenue piece for 271 million alone,
For now.
for now.
And I think we communicated that to Verizon. Our problem is franchise fees, that's our challenge, right? So that's why conflating the two, as you heard, sick of hearing me talk about it, is the challenge for us.
It seems to me that that's a proposal that needs to be brought up for a vote of the commission.
But is that our, I guess like the question was, I thought at the beginning we were looking at trying to get a little bit more data. Then people can kind of come forward with some types of proposals. So we're not looking to do that today. No, correct, okay. And is there some consensus that to the extent the staff can get the data that we requested? I understand if you have stuff that you can't do.
or some of it, or?
It would depend on what's requested. I mean, I haven't seen this. The documents.
Yeah, yeah.
Yeah, I think you and I have talked a bit offline. I think if we get the majority, in, as I said, we can ask for it. We have to be very careful.
Sure.
So we will be very careful. I mean, the more beneficial way to do this, I think, is if we do make proposals, we can provide the recommendation to give you the data. We can get started and we can go back and forth.
So I guess is that what's interesting is, and I think the wireless proposal led to this. There were some assumptions, and when you ran the numbers, it came out different than they thought. So now there's a sense to go back and try to redo it. So what we're looking for is if you could give a little bit of drill down on that data, then you can actually use that to craft the proposal, because at that point, you should be able to know what the impact of the proposal is by taking the data that you're giving us.
Yeah, on some of it. And if you're going to stick to statewide, a lot of the disclosure issues go up.
And that is why I did try to break it into state compared to what's in local as a way of trying to help us see, can we at least get to part of it?
But I think what needs to be done, whatever we're doing needs to be done within the next couple of weeks so that we can fit ourselves into that next, what's the next scheduled date? June 12th.
As there are localities that have taxing authority, are we anticipating what they will and won't do and how it might impact consumers? Because if they have a taxing authority, is the new proposal going to eliminate that taxing authority? Because if there's a direct reduction, that would be a good thing for consumers. I'm in one of those taxing authorities, and I understand and have seen the history of the behavior there. So what would preclude them from turning around and picking up that slack and raising the tax?
Not much.
Okay, anything else that we need to talk about today before we go off to work some more? Okay.
Thank you all for all the time that you put into this. It's way more of an issue than I even dreamed it was when I put the legislation in. And I really appreciate all the support that you all have been to this.